Yes.
Hello everyone, welcome. This is Assistant Professor at IIMT College of Management. And today we are going to explore the critical landscape of angel investing and venture capitalist funding, opportunities for early stage startups. Whether you are just formulating an idea or looking to scale, understanding how to fuel your business to finance is one of the most important steps in your entrepreneurial journey. Let's start by defining our first major funding source, the angel investor. Simply put, an angel investor is typically a high net worth individual who provides financial backing for small startups or entrepreneurs. In exchange for their investment, they usually require ownership equity in your company. Unlike institutional folks, angel investors are often investing their personal funds and can also act as valuable mentors who have been in your shoes. Now contrast that with venture capital. Venture capital is a form of private equity. It is type of financing provided by investment firms or funds to startup companies and small businesses that show strong potential for long-term growth. VCs typically come in and later stage and angel investors, bringing larger pools of money, institutional backing, strategy networking to help a company scale this. When weighing angel capital versus venture capital, consider what is best for your startup's current stage. Angels are generally best for seed phase when you are getting off long and need smaller capital. VC steps in later when you have proven business models and need significantly more capital to capture market expansion and market share. Your choice depends entirely on your group stage, the amount of money you need, and how much control are you willing to give. Why is funding required? You might ask, why actually do I need external funding? Bootstrapping is great, you do not need to sacrifice a little, but scaling requires capital. Funding is essential across every vertical of new business. It covers prototype creation, product development, and allows you to hire a competent team and gives you a working capital to keep your lights on. It also pays necessary legal and consultancy services, raw materials, equipment, licenses, marketing and sales efforts, and basic office space and administrative expenses. There are 5 stages to VC funding. If you go to venture capital, they usually happen at 5 different stages or 5 different levels. The first is seed. Usually at seed level, the angel investing is more preferred, but sometimes venture capital do invest at seed level. This is when you are getting the initial idea of the loan. Next is startup, where you are funding product development and digital marketing. Here as well, usually angel investing is preferred, but sometimes venture capitals do invest at this point as well. The next is first stage, funding early manufacturing and sales stage. This is where usually the venture capital firms excel at. The next is expansion, when you are scaling your business, entering new market, be it horizontal expansion or vertical expansion, and accelerating the growth. The last is bridge financing. This is the final stage of funding by a venture capital. Usually venture capitals do not invest further than this. This is when you are preparing a company to go public or launch it IPO. Before approaching these investors, you need to have your house in order. You must know how to properly begin a startup. This involves building strategic financial management plan, so you know exactly where every rupee is going. Once you have a solid foundation and financial roadmap, you can focus on selecting the right investors who align with your vision and can offer significant strategic value beyond just a bank check. Terms and conditions of investment. When you do find the right investor, be prepared to navigate the terms and conditions of that investment. Keep the 7 rules in mind. First is to ensure the capital aligns with your overall financial goal. When you liquidate your equity, the other person or other firm also get to say in your business decision. It is very important that you are completely agreeing to the terms and conditions of the business proposed by them. Second is to have a clear understanding of the risk involved. The third is to make sure that you have a diversified investment portfolio. Raising funds through equity alone is not a smart move. Clearly understand the valuation of your startup. Having a clear exit strategy for both you and the investor, and get absolutely everything in writing. And the last is to always consult a financial advisor or a legal counsel before signing. What investors are actually interested in. So, what are investors actually looking when they value your pitch? They are looking for the following: your core objective and specific problem you are solving, the capability and experience of the market, the broader market landscape and total addressable market, your consumer acquisition strategy and supply chain, a thorough competitive analysis, your sales and marketing execution plan, the rigorous financial assessment and valuation, and finally the exit revenue. How and when will you get when will they get a revenue? Aside from private investors, the government offers incredible backing through Startup India initiative. They provide several schemes to ease financial burden, including the City Fund of Funds Scheme, the Startup India Seed Fund Scheme, the Startup India Investor Connect platform, and the Credit Guarantee Scheme for startup. You can find all of these and the new ones on startupindia.in. To give you an idea of scale of government incubation support in India, there are currently more than 1,50,000 recognized startups in India funded by the government of India, and there are more than 231 active business incubators functioning in India. Furthermore, seed funding grants often require early capital, up to 20 lakhs, to build the proof of concept and take your first steps. Thank you for your time and attention. I hope this provides a clear roadmap and understanding for your community.